In the first half of December, the United States oil futures experienced their seventh consecutive week of declines, marking their longest losing streak in the past 5 years. This prolonged drop has raised concerns among analysts about the rising production of oil globally, which has overshadowed the Organization of the Petroleum Exporting Countries, OPEC, efforts to limit the supply. OPEC and its allies, including Russia, agreed to cut oil output by 2.2 million barrels per day through the first quarter of 2024. However, market experts believe that not all the members will adhere to this agreement, which has further contributed to the pessimistic outlook for the oil market. In this video, we'll talk about the recent oil market developments and how they may affect the American economy. But before moving on, consider subscribing to the channel and hitting the notification bell. Ensure you always stay on top of America's most important economic news. Thank you. Now, let's get back to the topic. First, you have to remember that America's oil and natural gas industry supports 10.3 million jobs in the United States and nearly 8% of our nation's gross domestic product. Thus, any fluctuation, especially long-term downturns, will severely affect millions of American workers. Oil prices plummeted to their lowest level in 6 months on December 7 as concerns over slackening energy demand in the United States and China persisted, even as the U.S. output remained near record highs. Brent crude futures fell by 25 cents to $74.05 US a barrel, while U.S. West Texas Intermediate crude futures dipped by 4 cents to $69.34. Both benchmarks marked their lowest prices since late June. Brent's front-month prices started trading at a discount to prices in the past 6 months for the first time since June, indicating that traders believe the market may have become oversupplied. According to PVM oil analyst John Evans, with the largest global importer of oil, China, shuttering its thirst for crude, pressure remains on prices as the largest producer, the United States, continues with headline output. U.S. Energy Information Administration data revealed that the country's output was still over 13 million barrels per day, near its record highs. The U.S. gasoline stocks rose by 5.4 million barrels last week to 223.6 million barrels, which is more than 5 times the 1 million barrel build that has been anticipated. Moreover, concerns about China's economy also weighed on oil price gains. Chinese customs data showed that crude oil imports in November fell 9% from a year earlier due to high inventory levels, weak economic indicators, and slowing orders from independent refiners, leading to weakened demand. Although China's total imports dropped by a monthly basis, exports grew in November for the first time in 6 months, suggesting an uptick in global trade flows may be helping the manufacturing sector. The EIA's recent report says the U.S. is anticipated to witness a seasonal increase in gasoline inventories from October 2023 to January 2024, characterized by refinery maintenance completion and low motor gasoline demand. Despite a projected 30 million barrel below average inventory build, current levels surpass those of the previous year, with expectations for a continued increase in January 2024. Future prices for gasoline blend stock (RBOB) for spring 2024 delivery are higher than those for the upcoming winter, incentivizing refiners and storage operators to accumulate stocks for later profitable sales. RBOB future prices for April 2024 averaged $2.29 per gallon, compared to $2.08 for January 2024. The surplus in gasoline inventories is predicted to contribute to a 15 cents a gallon decrease in the U.S. Gasoline crack spreads in 2024 compared to 2023, leading to a reduced annual average U.S. retail gasoline price forecast from over $3.50 per gallon in the current year to under $3.40 per gallon in 2024. In terms of petroleum and other liquids net exports, the U.S. is expected to set a new record in the coming year, driven by increased crude oil and hydrocarbon gas liquids (HGLs) production. While 2023 saw substantial growth in HGL production, a slight slowdown is projected for 2024 due to rising U.S. HGL consumption. Despite remaining a net crude oil importer at approximately 2.2 million barrels per day, the U.S. will experience a decline in net crude oil imports compared to 2023. Continued growth in U.S. crude oil production, largely exported to Europe and Asia, will contribute to an overall increase in net U.S. petroleum exports. So there will be less income from crude oil exports, and if the prices of oil continue to fall, this will bring rough times for oil manufacturers and millions of workers. But why are low oil prices bad for the U.S.? According to the Federal Reserve Bank of Dallas article of 2020, how falling oil prices in early 2020 weakened the U.S. economy, the West Texas Intermediate WTI oil price experienced a significant drop from January 21 to April 3, sparking expectations of positive economic impacts due to historical views that lower oil prices benefit the U.S. economy. Contrary to this expectation, the article argues that the decline in oil prices has, in fact, weakened the U.S. economy, distinguishing it from past instances of falling oil prices. The traditional belief that lower oil prices stimulate U.S. aggregate demand through increased discretionary income is challenged by factors such as the reduced relevance of petroleum imports, altered consumer behavior during the pandemic, and the impact of the shale oil revolution. The article emphasizes the diminished role of consumer spending on gasoline, especially amid pandemic-related restrictions, and notes the changed dynamics of the U.S. economy following the shale oil revolution. Additionally, it highlights that the decline in oil prices was driven by lower U.S. demand, contributing to a lack of economic stimulus. Furthermore, the article discusses the negative impact on the U.S. economy through the oil sector investment spending channel. Despite potential benefits from lower production costs for businesses, the reduction in capital expenditures by oil companies has offset any consumption stimulus, negatively affecting U.S. investment spending and overall economic growth. The potential implications for the banking system are also addressed, with concerns raised about the stability of banks heavily involved in lending to oil companies. However, the analysis suggests that 2020 banking exposure to the oil sector is not as significant as during the 2007-09 housing crisis. There's no evidence of widespread spillover effects into the banking sector. The decline in bank stocks is attributed to broader financial stress and falling interest rates rather than a direct systematic impact of lower oil prices. Moreover, the current drop in oil prices is generally beneficial to consumers, but there's a concern that they might fall too low, potentially impacting certain sectors of the U.S. economy. The widespread use of hydraulic fracturing in the mid-2000s revolutionized oil extraction, making it economically viable to tap into shale deposits. This technological advancement and rising global oil prices led to a surge in domestic production, creating jobs and keeping more wealth within the U.S. However, the lower oil prices can pose challenges to regions heavily dependent on the oil industry, potentially causing economic downturns and job losses, as witnessed in 2015 and 2016. In 2015, the energy sector experienced a significant setback, as the plummeting oil prices led to a halt in job gains and resulted in the termination of more than 258,000 jobs worldwide, as per the analysis by industry consultant Graves & Company. The number of active oil and gas rigs in the U.S. fell 61% to 698 as of December 31, compared to a year earlier, according to Baker Hughes rig counts. While some argue that around $50 per barrel is still sufficiently high to support profitability due to increased efficiency in fracking, concerns linger about the economic impact on regions heavily reliant on oil production. The U.S. economy, with its diversified sectors, is somewhat insulated. But specific regions and businesses supporting the oil industry may face challenges if prices drop significantly. Notably, experts dispute the notion that lower gas prices automatically lead to increased consumer spending and economic stimulus, citing similar declines in 2012 without significant economic growth. JP Morgan Research has recently forecasted that Brent oil prices would stay mostly steady in 2024, then decline by a further 10% in 2025, after experiencing a fall in 2023. The head of the global commodities strategy at JP Morgan, Natasha Kaneva, stated that their Brent forecast has remained unchanged since June and anticipates averaging $83 per barrel in 2024. However, the duration of low oil prices remains uncertain, with global factors such as U.S. sanctions on Iran, Saudi Arabia's production decisions, and potential OPEC production costs influencing market volatility. Situation highlights the continued dependence of the U.S. on global oil markets, emphasizing potential global consequences even with increased domestic oil production. Thank you for watching. If you enjoyed the video, hit the like button. Feel free to share your thoughts on the subject in the comment section below.